Hey Josiah, what's going on today?
Nothing. I'm good.
All right, cool. A lot of kids your age don't know simple financial concepts and terms, but I know you do, right?
Yeah, I do.
All right, cool. So let's run down something. What is an asset?
An asset is a resource with economic value that an individual, corporation, or country owns or controls with a expectation that it will provide a future benefit.
Okay, but stop. What's economics?
Economics is the study of how people give little resources for production, distribution, and consumption, both individually and collectively.
Okay. What else about an asset?
Assets are reported on a company balance sheet and are bought or created to increase firm's value or benefits firm's operations.
Oh, nice. Keep going, Josiah. Keep going.
An asset can be thought of as something in the future can generate cash flow, reduce expenses, or improve sales, regardless whatever the manufacturing.
All right, nice. Now, what is a liability?
A liability is something a person or a company owes, usually a sum of money.
Okay, and what else?
Liabilities are settled over time through the transfer of economic benefits, including money, goods, or services.
All right, and what is economics again?
Economics is the study of how people give little resources of production, distribution, and consumption, both individually and collectively.
Nice. Is there anything else on liability?
In general, a liability is a obligation between one party and another, not yet completed or paid for.
You're doing great, King. You're doing great. So what is equity?
Equity plus liabilities equals assets.
Okay, smart one. But what is equity?
Oh, assets minus liabilities.
I see you know your math, but what is equity?
Equity represents the amount of money that would be returned to a company's investors if all of the assets were liquidated and all of the company's debt was paid off.
Okay, nice. And what's liquidated?
Liquidation is the process of bringing a business to an end and distributing its assets.
And what's an investor?
An investor is any person or other entity who commits capital with an expectation of receiving financial returns.
Nice. And what's capital?
Capital is a term for financial assets, such as funds held in deposit accounts or funds obtained for special financing sources.
Nice. And what type of capitals are there?
Capitals can include cash equivalents and marketable securities, as well as manufacturing equipment, production facilities, and storage facilities.
All right, okay. And what is a balance sheet?
A balance sheet is a statement that reports a company's assets, liabilities, and equity at a point in time.
Okay, and what else?
And it provides a basis for calculating rates of return and evaluating its capital structure.
All right, and what is a capital structure?
A capital structure is a particular combination of debt and equity used by a company to finance its overall operations and growth.
All right, so we went over equity, but what is debt?
Debt comes in the form of bond issues or loan, while equity may come in the form of common stock, preferred stock, or retained earnings.
All right, keep going.
Short-term debt, such as working capital requirements, is also considered to be a part of the capital structure.
All right, nice. So what is the cash flow?
Cash flow is the net amount of cash and cash equivalents being transferred into and out of a business.
So simply put, tell me in a simpler way.
Well, the company's ability to create value for shareholders is determined by its ability to generate positive cash flows, or more specifically, maximizes long-term free cash flow.
All right, and what is free cash flow?
Oh, FCF Well, that represents the cash a company generates after counting its cash outflows to support operations and maintain its capital assets.
And what is a business capital asset?
An asset with a useful life longer than a year that is not intended for sale in the regular course of business's operation.
And what does that make it a part of?
The production costs.
And what's the production cost?
Well, that reflects all of the expenses associated with a company conducting its business, while manufacturing costs represent only the expenses necessary to make the product.